Hi, this is Ron Cipcic, and this is the first part of a three-part series on the complex circular flow model. The complex circular flow model is one of the most important macroeconomic models we'll look at. It's going to give us a visual picture of how the macroeconomy hangs together. Moreover, it will allow us to really understand the national income and product accounts that our government uses to measure our macroeconomy and its performance. To begin our analysis, we really need to go back to the simple circular flow and remember some of the key concepts there. So we start with the business sector, and we add in a household sector, and we recall that that household sector and that business sector were related in a very, very important way. Businesses sell goods and services to households. Households make what are called expenditures. So expenditures represent, in dollar terms, if we're looking US, dollar terms, what households actually spend on goods and services. Those funds flow over to the business sector. They're no longer called expenditures over here. They're called revenues. So businesses call those funds that flow in revenues. And then businesses take those revenues and they make what? They make resource payments. They pay for the resources that they need to produce goods and services. And if you recall, when I talked about the simple circular flow, I mentioned that there were actually four basic resource payments. The most important is wages. So you got wage payments, you have rent payments, payments for land or natural resources. You have interest payments, which are the payments for capital, and you also have profit payments, which are the payments to the owners for their entrepreneurship. So these four basic types of resource payments end up flowing over to the household sector, and they become what? They become income. So there's actually four basic types of income: wage payments, rent payments, interest payments, and profit payments. Now look, the most important of the four resource payments or income payments is wages. If you look at macroeconomic data, you'll see that wage payments far and away are the largest income payment because labor is the most important input in the production of output. Even in a day of great mechanization and automation, labor is still the primary input that goes into making things. Now, very important to remember, this is a flow model. This is simple, circular flow. Flow is the operative word right now. Income is a flow, an amount measured over a specific period of time. Expenditures are a flow measured over a specific period of time, and so on. These are all flows. These say nothing about stock values. So let's say this data is for 2014. This is the incomes paid to members of households in that year and that year only. These are the expenditures made by those households in 2014 and in no other year. Now look, households are using things all the time that they bought in previous periods. For instance, I drive a 2003 Camry. That car was counted as part of expenditures way back in the early 2000s. That car still provides me with value. I drive it almost every day. And yet, the value of that car is not incorporated into the circular flow analysis. So only current expenditures, current income, current revenues, and current resource payments, that is if current is 2014, only current values are included. That is very, very important to remember. Now, income may flow into a household, and we'll learn later on that households may save part of that and accumulate wealth. Wealth is not income. you can earn, $100,000 a year and have no wealth because you spent all of it. In fact, in simple circular flow analysis, that's exactly what it assumes. It assumes that all of your income flows in and all of it flows out. Let's take a look at those three assumptions, because they are going to be the foundations for moving ahead with our complex circular flow analysis. So let's be reminded of what our three assumptions are. Let me go back up here and get my pen tool working. So the three assumptions that we made when we developed the simple circular flow model. One, we assume that there's no saving, and we assume there's no investment. Okay? So that assumption is actually going to be the first assumption we deal with. We're going to pull this assumption off. We're actually going to remove this assumption, and we're going to show you how that affects the model. The second assumption is the no government, no taxation assumption. And of course that's unrealistic. We have government at the federal, state, and local level in the United States, and government plays a very important part in economic activity. In the next video, in video 2, we will actually remove that assumption, and you'll see how that affects the model. And then finally, the last assumption is the no foreign sector assumption. And basically we're assuming a closed economy. In other words, all buyers are what? Domestic buyers. All sellers are domestic sellers. In our third video, we'll actually pull that assumption off. Now let me go ahead and move this out of the way, and we'll actually begin to draw the complex circular flow model. Again, the first thing we'll do is we'll incorporate saving and investment. Okay. Now what I would do if I were you is I would take a sheet of paper, turn it sideways, and we're going to draw a model that's fairly elongated. So we'll put the business sector over here. We'll start with our two basic sectors, the business sector and the household sector. And I'm going to square this model off a little bit. I'm not going to make it quite as round as we were before, so it'll still have round corners, but we're going to square it off. It'll be easier to draw if we do that. Okay, now I'm not going to put any of the simple circular flow labels back in. I just assume that you know those. So again, let me remind you, this quadrant over here, this corner over here, the northeast quadrant of the model is expenditures, right? The northwest quadrant of the model is going to be what? It's going to be revenues. The southwest quadrant of the model will be what? That will be resource payments. And the southeast quadrant of the model, the lower right quadrant, will be the income side of the model. And keeping that in mind, later on, when we have lots of flows in here and lots of labels in here, will actually help you keep things straight. Now, let's dive right in. We know that income flows into the household sector. Okay? We already know that. Later on, we'll give a name to this. This has a special name, but for right now, we'll just call it income. Most of that income that flows in during this current period is spent. So the data shows that most of household income, it's called personal income, most of it is spent in the current period. There's a name for this spending. It's called consumption expenditures. Now, in the simple circular flow, it's just called expenditures, but now we add a descriptor to it. We call it consumption expenditures. Why? Well, there's going to be more than one type of expenditure. There's going to be more than one type of spending. If you only have one type of bird, you're going to call that animal a bird. But if you've got 1,000 different types of birds, you're going to have to distinguish each bird from another bird. And that's where you're going to have to give names. So you're going to call a robin because you want to distinguish it from an eagle or a sparrow or a crow or whatever. So we're going to put a descriptor on expenditures because this is just one of actually 4 basic types of expenditures that we're going to be looking at. Now, some of the income that flows into the household sector is actually going to be saved this period. We are not saying that all households save. We are saying households as a group save. So your household may not save. In fact, your household may actually spend more in the period than it received in income. That's actually called dissaving. Dissaving is the opposite of saving. What we're assuming is households collectively save in this model. So we're going to draw an arrow from the household sector into something called the credit market. We'll abbreviate that CM. Talk more about the credit market in just a minute. This flow will be called net saving. Now, why do we put a net in front of the word saving? We need to acknowledge that money is flowing from households into the credit market when households save. But money is also flowing from the credit market back into households when households borrow. What we're going to assume here is that households in this current period saved more this year out of current income than what they borrowed this year against current income. So we're going to assume a net saving flow. Now look, we could put two arrows in here if we wanted to. We could have a saving flow coming right to left. We could have a borrowing flow coming back left to right. But to keep it simple, or as simple as we can make it, we're just going to consolidate these two flows and make them one flow. Okay? Now, a word about the credit market. The term credit market is also known as the loanable funds market. It's called a lot of different things by people in the world of finance. We're going to call it the credit market, at least at this point. It's made up of many, many, many different types of institutions. We don't have time to go into all of this. But the point I do want to make is, out of current income, when households save, there are vehicles for that saving. There are ways for that saving to take place. For instance, the household could put funds into a bank account. The household could put funds into a credit union account. The household could put funds into the bond market. The household could put funds into a stock market account. There are even insurance funds and all sorts of instruments by which a household can save. For instance, I take part of my monthly income. I actually get paid twice a month. I take part of my monthly income and I put that income into mutual funds. Mutual funds are funds managed by a manager, a mutual fund manager, who takes those funds and puts them into stocks or different types of financial instruments. That person is supposedly an expert. They know much more about the stock market than I do. So I entrust my funds to them. They put my funds into stocks. Hopefully those funds generate a return. And I am doing this for retirement purposes. So I'm hoping that every year that fund grows. It not only grows fast, it not only grows because I put funds into it, it grows because those funds are actually earning a return. Okay? So I am saving when I put funds into a mutual fund. I am actually saving out of my current income. Now note, the term saving indicates a flow. I'm not talking here about my savings accounts. I have savings accounts. I have a savings account at a bank, a checking account, but I also have an emergency fund, a cash fund that I have set aside in case my wife and I hit an emergency. And I also have a retirement account, which is really a savings account. It's a stock fund, but it's really a way that I save. A savings account is not a flow. It's a stock. It's not shown on this model. What this model is showing, and this is critical that you understand this model is showing what is saved this year out of this year's income. So if this is 2014, this is what is being saved out of 2014 income. Okay, let's move on. Some of these funds will be borrowed by businesses. So there's something called business borrowing. You go, why do businesses borrow? Well, apparently revenues are not enough. Not enough for what? Businesses want to turn around and they want to invest. Look, if you're a business and you want to build a building, your current revenues may not be sufficient to cover the expense of building a building. So you may have to borrow. And so you go to a bank, you get a line of credit, you get a building loan, and you begin to build your new factory. The bank finances that. You're going to be receiving funds periodically from the bank. Okay? Why are you borrowing? You're borrowing so you can turn around and what? So you can invest. This is called actual investment. Actual investment. Now, this word investment warrants special treatment. And the reason I'm going to give this a little special treatment, I'm actually going to take some time and write this out, is because it's so misunderstood and misused, this term investment. Look, when I receive income and save it and put it into my retirement fund, and when my retirement fund manager puts it into stocks, that is not investment. Now, do people call that investment? All the time. But from our standpoint, that is not investment, that is saving. When I save funds and put it into a retirement fund in the form of a stock fund, I am saving, not investing. The question is what is investment then? It's business what? Business spending on what? On capital goods and inventory. Now we're not going to worry about inventory right now. But when a company builds inventory, when they make goods, final goods, or when they make goods work in process, when a company builds inventory, economists consider that investment. But what our focus will be more on are capital goods. A company builds a building. A company buys a new vehicle. A company buys new equipment. A company brings new computers into its office setting, new office furniture. All of these things, gives its workers new tools. All of these things constitute investment. The purpose of investment is to increase the firm's productivity and allow it to produce more output. Remember what capital is. It's a human-made resource used to produce goods and services. Okay? So that's what we're talking about. Any business spending on capital is going to be captured in this actual investment label. Okay? So it's very important you begin to distinguish the difference between a saving flow and an investment flow. They're very, very different. We will use investment very, very carefully in this course, only because we have to. If we don't, we're going to get very, very, very confused. Okay, back to blue. Businesses also save. There's two basic ways that businesses save. Now, I am painting, no pun intended, with a very broad brush here. But I want you to kind of get, this idea in your head that businesses save, and there's two basic channels. One is called depreciation. Sorry about that. Depreciation allowances. Okay, say the business we're talking about it's a delivery business, it's a trucking business or delivery business. The main asset that the company uses is trucks. And these trucks wear out. They have a useful life of, let's say, 5 years. They're driven very hard, they're driven long distances, there's lots of weight put on them. These trucks wear out, the company estimates, every 5 years. Will this company have to set aside funds over the course of a 5-year period to replace its fleet of trucks? The answer is yes. The funds that are set aside to replace worn out or obsolete capital is called depreciation allowances. Okay? Now some of you may have had an accounting class where you've learned about the tax treatment and the accounting treatment of depreciation. Don't worry about that. We want to think of depreciation as basically a savings account, an allowance. It's the idea of an allowance. Funds set aside for the replacement of worn out capital. Okay? That's critical. Let me move the picture over a little bit. Okay, now there's a second basic type of saving, and it's called retained earnings. Remember, the owners of the firm are entitled to the profits. Some of those profits that the firm earns will be paid down to households, dividends. Dividends would be part of that. So, say Kellogg's, we're talking about the Kellogg Company. Kellogg's pays dividends every quarter, which means it takes some of its profits and distributes those profits to anyone who owns a share of stock in the Kellogg Company, any owner. So some profits are distributed as dividends, but some profits are actually retained. These are called retained earnings. Why do companies retain earnings? Well, Kellogg's may want to buy some new equipment, expand the size of its business. So it knows that if it buys this new equipment, expands its production facility, it will be able to churn more cereal out, sell more cereal, and take more of the cereal market. So sometimes companies will retain earnings to grow their business. Notice the difference here. We're not retaining earnings to replace worn out capital. We hold depreciation allowances for that purpose. We are actually retaining earnings to try to expand or grow the business beyond its current size. Okay? So what we see then is we see businesses basically saving two ways. They use depreciation allowances and they use retained earnings. These are both business saving. Notice I could have channeled these two flows into the credit market, which would be, I think, more realistic. Businesses borrow from the credit market, but businesses also save into the credit market. So it's likely that when these funds are initially saved, they go into some sort of account. Okay? That would be very reasonable to believe. But the point is, if I bring them into the credit market, I got to bring them back when I go to invest them. So I just want to skip all that movement. So I'm just going to have them come out of the business sector and go directly into the investment flow, since that's really what they're designed for. Okay? So businesses really have three sources of funds. They can borrow, they can retain earnings, or they can hold depreciation allowances to finance their what? To finance their investment. And then also we've incorporated in the whole concept of household saving. So notice we've now incorporated saving and investment into our model.